Mortgage rates just dipped below 6% for the first time in 3 years. And it's a trap. The headlines are calling it a thaw, but the data shows it's actually the bait. While you were watching the 5.9% sticker price, the Federal Reserve was quietly swapping billions in mortgage support for government debt. They didn't fix the housing market, they abandoned it. And today, I'm going to show you the internal Fed plumbing that proves this thaw is actually the start of a structural freeze. I'm Tim. I use HeyGen to deliver these breakdowns 3 times a week because speed matters. But the plumbing, the charts, the conclusions, that's all me. You saw the chorus of celebration in the last week of February. Smiling analysts, real estate agents flooding your feed with hope, homebuyers feeling that sudden jolt of optimism. That feeling was exactly what the government wanted you to have, but it was a masterfully crafted illusion. Because as of today, March 3rd, 2026, the bait has been pulled. Rates are already ticking back up. This isn't a recovery, it's a recalculation. And the jaws of the trap are hiding on a $6 trillion balance sheet. Let's dissect the good news that wasn't real. On February 26th, Freddie Mac hit 5.98%, a huge psychological barrier. For the first time since September of 2022, the psychological dam seemed to break. The narrative was simple. Inflation is tamed, the Fed is easing, and the path is clear for a more affordable housing market for everyone. But here's the question nobody asked. Why? What fundamental force granted this relief? Did productivity explode? Did the debt disappear? No. It wasn't the free market. It was a brute force political intervention. In January, the admin issued a directive ordering Fannie Mae and Freddie Mac to go into the market and purchase a massive $200 billion worth of agency mortgage-backed securities. To understand the scale, that is like a billionaire walking into a small local auction and bidding on every single item regardless of the price. The yields crashed because the demand was artificial. That is a policy earthquake. It created a temporary sugar high that squeezed spreads and gave us that sub 6% headline. But unlike the Fed, Fannie and Freddie have a profit motive. They aren't bottomless pits of liquidity. They cannot be the permanent price-insensitive buyer the market grew addicted to. The proof? Rates are already back above 6.1%. The sugar high is over. While the media was focused on the political theater of that $200 billion buy, the real story was hiding in the plumbing. To understand the trap, you have to understand the whale. For 15 years, the Federal Reserve used a process called quantitative easing to become the single biggest buyer of America's mortgages. At the peak, they didn't just own a few bonds, they held $2.7 trillion in mortgage-backed securities. Think about the sheer gravity of that number. They weren't just a market participant, they were the floor, the ceiling, and the walls of the entire housing market. When the Fed is your number one customer, risk essentially disappears from the math. Private banks didn't have to worry about who would buy their loans. They knew the Fed was waiting with an open checkbook. This artificially squashed the spread, the extra interest you pay on top of the 10-year Treasury yield. They subsidized your mortgage, your equity, and your lifestyle for a decade. But now, the whale is swimming away. It's called quantitative tightening. And the way they're leaving is the fine print everyone is missing. The trap has 3 distinct mechanical parts. First, let's look at the runoff. The Fed's official plan was to let $35 billion in mortgages simply roll off the books every month as people paid them back. But that plan is failing. Why? Because of the lock-in effect. If you have a 3% mortgage from 2021, you aren't selling. You aren't moving. You aren't refinancing. That means the prepayments have dried up. The physical churn of the housing market has slowed to a crawl. The Fed is now stuck holding $2 trillion in assets that they desperately want to dump, but nobody is paying them back fast enough. They are like an investor who wants to liquidate a position but discovers there are no exits in the building. This leads to the second part, and this is the smoking gun for 2026. It is the reinvestment deception. When the Fed does receive a principal payment from a mortgage bond now, they are no longer letting that money disappear or reinvesting it back into housing. Instead, they are taking that capital, money that originally supported an American home, and they are using it to purchase short-term treasury bills. I want you to stay with me on this because it is the pivot point of the whole decade. The Federal Reserve is now systematically taking liquidity that supported the housing market and using it to fund the US government's deficit. They are trading your home's support system for banking system stability and debt management. They aren't just leaving the housing building, they've officially joined the other team. They are swapping housing collateral for government collateral. This isn't just a policy shift, it's a structural divorce from the housing market. This brings us to the third piece of evidence, which is the clearest danger signal we have: the MBS-to-10-year spread. This is a technical term for a very simple reality. Usually, mortgage rates track the yield of the 10-year Treasury note, plus a small margin to cover the risk of the loan. When the Fed was gobbling up every bond in sight during QE, they didn't care about risk, so that margin was artificially squashed down to almost nothing. Now that the Fed isn't buying and they are actively pulling liquidity away, the only buyers left are private investors like pension funds and insurance companies. Unlike the Fed, these people actually care about getting their money back. They care about risk. And right now, the risk for mortgages is seen as very high. As a result, that spread has ballooned. It is currently hovering at 200 basis points, or 2 full percentage points. That is the danger zone. What this means for you is that even if the Fed manages to tame inflation and the 10-year Treasury yield stays flat, your mortgage rate will stay stubbornly high. Why? Because the private market's risk premium has permanently doubled. The floor for mortgage rates has been raised. The Fed-funded party is over, and the private market is checking the receipts. So what does this structural freeze actually mean for your wallet? First, it means headline rates are a marketing gimmick. As the Fed pulls liquidity to fund the Treasury, banks are tightening their standards. They don't want a 30-year mortgage on their books when the liquidity environment is this unstable. They want higher down payments. They want perfect credit scores. They are scrutinizing every single debt-to-income ratio like never before. The headline rate might say 5.9%, but if you don't fit into an extremely narrow box, you aren't getting that loan. The liquidity is disappearing into the hands of the government, leaving less for the consumer. And that sudden rise in inventory that the news is calling a thaw? Don't be fooled by the surface level data. In early 2026, active listings were up over 15% year over year. The mainstream media wants you to believe this is a healthy sign of a market returning to normal. But look at the mechanics. In a market where borrowing costs have structurally reset higher and where the buyer of last resort has left the building, people aren't listing their homes because they want to move up to a bigger house. Increasingly, they're listing their homes because the economic pressure of the last 3 years is finally catching up to them. They're listing because of job losses, debt stress, or the realization that the equity they thought they had is locked behind a door they can't open. This isn't a healthy supply increase. It is the beginning of forced selling into a market where the buyer's demand is being systematically choked off. The political fix from the administration was merely the cover for this permanent structural change. It created the illusion of affordability to keep the system moving while the big players made their exit. Now take a step back and look at the bigger picture. We have reached a point where the Federal Reserve values government and banking stability over the American dream of home ownership. They have decided that the housing market must be the sacrifice to keep the Treasury funded. By swapping mortgage-backed securities for Treasury bills, they are effectively starving the housing market of the very lifeblood that kept it growing for 15 years. This is not a temporary blip in the data. This is a fundamental regime shift. If you are waiting for 3 or 4% mortgage rates to come back, you are waiting for a world that the Fed has explicitly decided to end. The risk premium is the new reality. The 200 basis point spread is the new reality. And a housing market that no longer has a government backstop is the world you are living in now. The headlines celebrated the bait, that brief moment when rates hit 5.98% through a one-time government spending spree. But they completely ignored the trap. The Fed is finished subsidizing the housing market. They are reallocating your home's capital toward the national debt, and they are doing it in broad daylight while calling it reserve management. The real story isn't in what you hear on the nightly news. It's in the MBS to Treasury spread and the weekly reports on the Fed's $6 trillion balance sheet. That data shows exactly where the money is flowing, and it is flowing away from you and your property value. This isn't a return to normal. It's a new era of structural austerity for the housing market. To navigate this, you have to stop watching the price markers and start watching the plumbing. You have to understand that when liquidity leaves the system, the things that rely on that liquidity, like high home valuations and low interest rates, are the first things to break. We are witnessing the slow motion collision between political promises and financial reality. And in that collision, the structural mechanics will win every single time. If this analysis gave you a clearer picture of the hidden forces moving your money, make sure you subscribe to this channel and hit that notification bell. I track these mechanics every single week so you don't get caught in the next trap. If you found value in this breakdown, send it to one person who needs to understand the real reasons behind these rate moves. But as we wrap up, remember that the housing market is just one pillar of this economy. And as the Fed pulls this liquidity to protect the banks, those same banks are already making a move to protect themselves from you. Their first target is one of the most common sources of equity for American homeowners, the HELOC. In the next video of this series, I'm going to show you the new rule that banks are using in 2026 to freeze home equity lines of credit overnight without warning and based on data you didn't even know they were tracking. If you have equity in your home, you cannot afford to miss the next one. I will see you there.